Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money games big companies play. And trust me, this latest report from StartEngine Crowdfunding Incorporated has some serious twists and turns that will make you do a double take. Before we dive in, if you love getting the inside scoop on what these financial reports actually mean for companies, make sure to hit that subscribe button. And if you want to chat about these filings and other market trends with fellow enthusiasts, join our Discord community linked in the description below. Alright, so what we have here is StartEngine's quarterly report for the period ending the 30th of September 2025. It is basically their progress report card for the last 3 months, and it gives us a peek under the hood at how things are going. Let's kick things off by looking at the company's financial health snapshot, their balance sheet. As of the 30th of September 2025, StartEngine has total assets of about $71 million. That is a pretty big jump from around $52.5 million at the end of 2024. Where did all that extra money come from? Well, a huge chunk of it, over $20 million, is in cash. This is a really positive sign, showing they collected a lot more money than they spent. Their cash position went from about $10.8 million at the end of 2024 to a whopping $31.3 million by September 2025. That is a massive increase, suggesting a very strong quarter or a successful fundraising effort. And when we look at total assets, we see that growth across the board. Investments in private companies, for example, climbed significantly, going from $4.7 million to nearly $8.9 million. This indicates they are actively buying into private companies, likely as part of their strategy. On the other side of the ledger, their liabilities look pretty manageable. Total liabilities are about $11.2 million in September compared to $10.1 million at the end of 2024. Nothing too alarming there. But the real story here is in stockholders' equity. It shot up from about $42.3 million to almost $60 million. This huge boost in equity is mostly thanks to strong profits and perhaps successful stock sales. This growth in equity is a fantastic indicator of a company gaining value. Now, let's talk about how the company actually made its money and its profits or losses. This is where the real action is. For the 3-month period ending the 30th of September 2025, revenues were a little over $22.6 million. That is a huge leap, more than double the $9.6 million they brought in during the same period last year. And for the first 9 months of the year, revenues reached an impressive $92.8 million, up from $31.2 million in the prior year. This shows the company is growing incredibly fast. However, the cost of generating that revenue also went up significantly, from $5.4 million to $14.2 million for the 3 months, and from $16.4 million to $62.1 million for the 9 months. Yes, you heard that right, the cost of revenue for the 9 months shot up by nearly $46 million. This suggests that while they are bringing in more money, the direct costs associated with that revenue are also rising sharply. Despite the higher costs, gross profit still saw healthy growth. It went from $4.1 million to $8.4 million for the 3 months, and a massive jump from $14.9 million to $30.7 million for the 9 months. This tells us that even with increased expenses, they are still making more money on each dollar of revenue. And what about their day-to-day operating costs like salaries and marketing? Well, here is an interesting trend for the 3-month period. Operating expenses actually dropped by $3.7 million, from $11 million down to $7.2 million. This is likely due to cost-cutting measures mentioned in the report, like reducing headcount at the end of 2024. This combination of soaring revenues and reduced operating expenses has had a dramatic effect for the 3 months ending the 30th of September 2025. StartEngine reported an operating income of $1.15 million, a huge improvement from an operating loss of nearly $6.8 million in the same period last year. And for the first 9 months of the year, they went from a massive operating loss of $13.8 million to an operating income of over $6.1 million. That is a massive turnaround. This excellent performance is reflected in their net income. For the quarters, they went from a net loss of $6.8 million to a net income of $1.16 million. For the 9-month period, they swung from a net loss of $13.8 million to a net income of $6.15 million. This is a significant financial improvement. A big reason for all this success seems to be their StartEngine private offering. The report highlights that this has become their largest revenue generator in 2025. It allows accredited investors to buy into private, late-stage companies. This product alone brought in over $17 million in revenue in just the 3rd quarter of 2025. Compared to only about $5 million in the same quarter of 2024. it is clear this is a major growth engine for them. Looking at the statement of stockholders' equity gives us a clearer picture of how the company's value has grown. The additional paid and capital line item, which often represents money investors put into the company beyond the stock's par value, saw a huge jump. It went from 95.5 million at the end of 2024 to almost 107 million by September 2025. This indicates substantial investment, and most notably, the accumulated deficit, which is the running total of all past losses, significantly decreased. It went from a negative 61.1 million at the end of 2024 to a negative 55 million by September 2025. While still negative, this reduction of over $6 million shows they are making serious progress towards profitability. Now let's check the cash flow statement. This tells us where the cash is actually coming from and going. For the first 9 months of 2025, they generated nearly 6.2 million in net income. A massive swing from a loss of 13.8 million in the same period of 2024. That is a difference of almost $20 million. The cash generated from their core business operations is also incredibly strong. In the 9 months ending the 30th of September 2025, they brought in over $14 million from operations, a huge turnaround from a negative 4.9 million in the prior year. This means their actual business operations are generating a lot of cash. Financing activities provided almost $4.9 million in cash in the first 9 months of 2025, mainly from selling more of their common stock through their own platform, which is a smart way to raise money when you own the means of doing so. Digging a bit deeper into the company's operations, StartEngine is more than just a crowdfunding platform. They have a bunch of subsidiaries covering funding portals, registered with the SEC, transfer agent services, broker, dealer operations, and even an alternative trading system. They're building quite the financial services ecosystem. They also recently formed a subsidiary in Canada to expand their operations. The company acknowledges they've had a large cash inflow, mainly from StartEngine Private, leading to their current net income. They also mention cost reductions, like cutting staff at the end of 2024, which helped lower operating expenses. This shows a focus on efficiency. Oh, and there was a 20-for-1 stock split back in May 2024. Here we get into the nitty-gritty of how they account for things. They use the cost method for stock received as fees, but they write down its value by 33% if there isn't a clear market value. This is a conservative approach for these hard-to-value assets. Importantly, they note that they received no warrants during the period and did not impair any warrants they currently hold. Their investments in private companies are recorded at cost. They're buying into ventures in AI, fintech, sales technology, and more. This diversification in their investment portfolio shows a strategy to grow beyond just their crowdfunding platform fees. They use a fair value hierarchy to measure assets like warrants and stocks. Level 1 are things with clear market prices. Level 2 are based on observable data, and Level 3 relies on their own estimates and assumptions. A lot of their private investments fall into Level 3. This means their reported values for these assets depend heavily on management's judgment. For investments in stocks of private companies, they use a 33% write-down if there hasn't been a new funding round. This is a significant assumption and could impact reported asset values. They also have intangible assets notably acquired when they bought Seed Invest. This includes customer lists and intellectual property. They amortize these over time and regularly check for impairment. The amount for these intangibles is pretty substantial, valued at over $24 million. This section details their preferred stock Series A, Series T, and Series Seed and common stock. It shows how many shares are authorized and outstanding and their liquidation preferences. Holders of preferred stock essentially get paid back before common stockholders in certain events. They have 2 equity incentive plans that allow them to grant stock options to employees. Nearly 160 million options were outstanding at the end of September 2025. These options are a way to motivate employees, but they also represent a potential future dilution of common stock values. This is where management explains the numbers. They talk about the evolving regulatory landscape and how they're adapting. They highlight that StartEngine Premium, a consulting package for companies raising funds, and StartEngine Secure, their transfer agent service, are key revenue streams. They also launched StartEngine Gold in July 2025, a premium subscription for issuers. They're in a new and fast-changing industry with regulatory uncertainties. They admit they haven't always made yearly profits, but their recent performance with StartEngine Private has changed that. They also note that economic conditions like market volatility can significantly impact investor confidence and their business. For the 3 months ending the 30th of September 2025, revenues jumped 136% compared to last year, driven largely by StartEngine Private. However, costs also rose significantly, especially for StartEngine Private itself, which is noted as a lower margin product, but thanks to cost cuts in administrative, sales, and marketing, their overall operating expenses decreased by 34%. This combination of higher revenue and lower operating costs resulted in a swing from a significant loss to a healthy profit. Looking at the first 9 months of 2025, revenues were up a massive 197% compared to the same period in 2024. Again, StartEngine Private was the star performer here, with sales more than doubling. While regulation crowdfunding platform fees saw a slight decrease, likely due to timing of invoicing, regulation and commissions showed strong growth, as did StartEngine Premium. The cost of revenues for the 9 months also saw a dramatic increase, more than tripling to $62.1 million. This is heavily influenced by the cost of revenue related to the booming StartEngine Private business. Interestingly, even with the overall revenue surge, total operating expenses for the 9 months decreased by 14%. This was primarily achieved through significant cuts in sales and marketing and research and development expenses, likely due to workforce reductions. All of this led to a phenomenal turnaround for the 9-month period. They reported a net income of $6.15 million compared to a net loss of nearly $13.8 million in the previous year. That is an enormous positive shift. They also provide a non-GAAP measure called Adjusted EBITDA, which basically strips out interest, taxes, depreciation, and stock-based compensation. For the 9 months of 2025, Adjusted EBITDA was over $16 million, a huge leap from a loss of nearly $3 million in the prior year. This metric suggests strong operational profitability before accounting for certain non-cash or financing items. In terms of cash, they have over $31 million available as of September 2025, a significant increase from about $10 million at the start of the year. This robust cash position, combined with their operational performance, gives them plenty of runway. They don't seem to have any major debt or credit facilities, and no significant capital expenditure commitments. After the reporting period, on the 15th of October 2025, the board approved the issuance of 360,000 more employee stock options. This is a standard move to keep attracting and retaining talent. There was a past arbitration with an issuer that was settled for $2.1 million. Most of this was covered by insurance, and the company even recovered a portion of its initial payment. This seems to be a resolved issue. Now, let's talk about the risks. They operate in a rapidly changing, heavily regulated industry. They admit they haven't consistently made yearly profits, and future profitability is not guaranteed. The evolving regulatory landscape, both in the US and abroad, is a constant concern. They mentioned that new laws could negatively impact their business, and they've had to adapt to becoming a broker-dealer and operating an alternative trading system, which increases compliance costs and liabilities. A big risk is that they could be held liable for misstatements made by the companies that use their platform. They also highlight material weaknesses in their internal financial controls from past periods. Though they have implemented remediation plans, they are also cautious about relying too heavily on one main type of service and the potential impact of economic downturns. Competition is also a major factor with new entrants and established players in the fintech space. So, what is my take on StartEngine's latest report? It is a story of incredible revenue growth, especially thanks to their StartEngine private venture, which is clearly a massive success right now. They've gone from significant losses to profitability in a remarkably short time. The growth in cash and equity is very impressive. However, we can't ignore the rising cost of revenues, which, while growing slower than revenue, still eats into margins, and the heavy reliance on StartEngine Private, while currently a strength, also presents a risk. If that market shifts or faces new challenges, it could significantly impact the company. The company's past issues with internal financial controls are also a red flag. Even though they claim to be addressing them, investors will want to keep a close eye on whether those improvements are truly effective. Overall, StartEngine is showing impressive momentum and a clear strategy for growth, but the risks associated with a rapidly evolving industry, regulatory scrutiny, and reliance on specific product lines are definitely worth considering. Alright, that is our decode of StartEngine's latest filing. What do you think about their rapid growth and the risks they face? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into corporate financial reports. And don't forget to join our Discord community for more discussions. Thanks for watching, and I'll see you in the next one.